Hey everybody, Steve Antonioni here. Now I know what you're all thinking. Yes, I did shave, and yes, I do look like a newborn child, but that is not by accident. I turned 28 over the weekend, which means that I'm a year older. But since I shaved, I figured that takes off about 3 years. So net, I'm actually younger by 2 years. Little life hack for ya. Anyway, today I would like to talk to you about what I think is hands down the best investment you can make in the stock market today. Now, this is just my opinion. I am not telling you to buy anything. This is not financial advice. You know the drill. So allow me to set the stage on this. So according to this article right here, most stocks are flops. Just 1% of stocks account for all market gains. Well, what do they actually mean by this? Basically, this article talks about a study where they found that only 0.5% of all stocks over a 29-year period up to 2019, only 0.5% of all stocks accounted for almost 3/4 of the gains created by the US stock market. So in other words, if you did not own this very small select group of these special stocks, you would have been way behind the people who did. Now, fortunately for us, there is a super easy way that we can make sure that we do own these stocks. And I think this way is the hands down best way to invest your money in the stock market. Right now, I have about $60,000-ish of my money into this specific type of investment last time I checked. And my goal is by the end of the year to have this over $100,000. And this investment is, drumroll please, index funds. Okay, let me just show you something really cool to kind of act as a jumping off point into the world of index funds. So right here, I'm looking at the 1-year return on the S&P 500. And that 1-year return is 15%. Now, what this means is that let's say you knew nothing about investing, you knew nothing about money, about the stock market, nothing. But you just decided 1 year ago today that you were going to put your money into an S&P 500 index fund. You would have made 15% on your money. You did not need to know anything about investing. You did not need to do any work. There was no real minimum amount of money you needed to do this. You could have done it with $1 if you wanted to. It wouldn't have really done much. But the point is, it's accessible to everyone. That would have been the easiest 15% return on your money you would have ever made in your life. This is the power of index funds. And in this video, I'm essentially going to give you a little my version of like a crash course into these so you can see just how powerful they are as an investment tool. So let's take a moment here and talk about kind of where we're at in the macro cycle of the stock market here so we can kind of have a backdrop to know what we're working with. Basically, since the recovery in 2020 after COVID, almost every single asset went up and to the right. In this period of like really easy money, since so much money was being pumped into the economy, everyone piled into higher risk assets, and a lot of people made a ton of money and felt like they were the next Warren Buffett. You had a lot of new investors come in 2020, even 2021, but 2021 was a little bit harder for them, but they felt like they were on top of the world. They felt like they were stock market experts because they were just absolutely killing it. But while all of this was happening, while everyone was chasing all these high-flying, high-risk investments, I think a lot of people completely missed or completely skipped the step of learning about the fundamental, boring, basic building blocks of long-term investing. Index funds are one of these classic, boring building blocks of long-term investing. And that's for a very good reason. Now, people are starting to pay the price for chasing a lot of these high-flying, high-risk names in the stock market. And that's because we're beginning to see this easy money period come to a close. These periods never last forever. And we're starting to see, or we already have seen, a lot of cracks in various areas of the market as people sell out of these things and try and lower the risk of their portfolio because they realize that the easy money times don't last forever. But what should, barring any kind of like apocalyptic event, last forever is the reliable returns produced by owning index funds. I want to share with you a really cool post on Reddit shared by the user Kawamba. This basically shows you the incredible power of investing your money in index funds for the long term. Essentially what this chart is showing here is it's saying on the left hand side, you are seeing the length of time that you are investing your money for in the S&P 500 index from 1 year all the way up to a 40-year time period. In the next column over, you are seeing the mean return that you would have experienced investing your money for this period of time. Now, this is an annual return, so this is what you would receive year after year. The next column shares the deviation. And what it means by this is basically that 68% of the time, your investment would fluctuate by this amount given the time period that you're investing for. So to simplify that, basically you can think about this like the risk level you would experience. If you're investing for 1 year, you'll experience a much higher risk level in your portfolio than you will investing for 40 years. And on the right-hand side, we can see the win rate. And the way they categorized the win rate in this particular analysis was they are comparing it to the rate of return you could receive by essentially investing your money into treasury bills, which represents the risk-free rate, because treasury bills are considered a risk-free investment and have a fairly low rate of return because of that. So basically what we're looking at here is that if you invested your money in the S&P 500 for 1 year, you're looking at about a mean or average-ish return of 8%, pretty good. But your win rate is 64%. So that's basically saying that history has shown us that if you just invested your money for 1 year in the S&P 500, there's a 64% chance that you would get a higher return than just investing your money in treasury bills. Now, 64% is definitely better than 50-50 like you would receive maybe if you're gambling at the casino, but 64% still isn't really that great when it comes to long-term investing. And that's because a 1 year time period is not long-term investing. You can see that as we increase the amount of time that we're investing our money for, 5 years, 10 years, 20 years, 40 years, at that 40-year threshold, it now becomes a 100% win rate over investing your money in a treasury bill. This is the power. This is the reliability of investing your money this way. Okay, awesome. So index funds appear to be this really reliable way of investing for the long term. But what does it actually mean to invest in an index fund? Like what conceptually are you actually doing when you invest your money in the S&P 500? Well, let me do this little sketch for you to show you basically how it works in a nutshell. So in the stock market, you're gonna have a whole bunch of various companies, right? And their stocks are going to basically go on random trajectories all over the place, up and down, depending on if people want to own these stocks, how the company is performing, sentiment, momentum, all these various factors. Now, as somebody who wants to invest in the stock market, you might think that you have to choose a couple of these lines or one of these lines or however many of these lines you want, right? You might think that you have to choose which stocks you want to invest in. But if you were to invest this other way, investing in index funds, this is what you would be doing. This is a trend line that essentially represents the average movement of all the various lines of the stocks in the stock market. And as an index investor, you are pretty much quite literally buying this trend line. You do not have to pick and choose which individual line, which individual company you want to own. You can just buy them all and essentially receive the average. You will receive the trend line. So as an index investor, you don't have to worry about the financial performance of the companies you're looking at. You don't have to be able to do a discounted cash flow model. You don't have to keep up to date on the company's earnings calls. All you really have to decide as an index investor is you basically just have to believe that the economy is going to continue to grow as a whole. If you don't believe that, then you probably shouldn't be investing in the stock market at all, and maybe it would be a better idea for you to buy a bunker, some ammo, non-perishable food, and maybe some gold as well. All right, so we've talked about how we can kind of conceptualize index ETF investing, but now let's dive into the data so that you don't have to just take my word for it. I want you to be able to come to your own conclusion about investing investing this way. So the first example I'd like to show you is the hedge fund performance results for 2021. So this list here is basically comprised of hedge funds who have publicly available data about their performance. And we can see that compared to the S&P 500, only 3 hedge funds had a higher rate of return in 2021. This is just terrible. Now, of course, you could make the argument that we should be looking at hedge fund performance on a risk-adjusted basis because they're not necessarily trying to outperform the market. But I mean, regardless, most hedge funds charge a 2 and 20% scheme, which is a huge fee to be paying, especially when you're underperforming a very basic benchmark. So hedge funds, index funds, nice. The next example we have here is the SPIVA scorecard. Now this basically measures the performance of active money managers versus passive index benchmarks. So simply put, if that made no sense to you, this is basically saying what percentage of professional stock pickers, so like financial advisors, wealth advisors, investment advisors, fund managers, what percentage of these people were able to pick the right stocks. Remember that little drawing I showed you earlier? We're able to pick the right stocks that beat the passive index, or in other words, that beat the trend line. So the data shows that over the past 10 years in the US, only 17.5% of these professionals were able to beat the index. Once again, this is pretty terrible. That's worse odds than just going to Vegas. Now, okay, so that's only 2 data points here. So how about another example? So this is the Morningstar Barometer. And this one shows an even worse picture. And that's because this one is looking at the past 20 years. And we can see that only 10% of professional fund managers beat their respective index in this particular category. And you can see the other categories aren't really any better. A lot of them are even worse. Not sold still? Okay, how about Warren Buffett's famous bet? He bet a hedge fund manager $1 million that the fund manager wouldn't be able to beat the S&P 500 over a 10-year period. Now, whoever won this bet, they would donate the money to charity because, you know, Warren Buffett doesn't need another $1 million. And as expected, the hedge fund manager was absolutely just spanked by the index. Just like they were once again in the New York Times contest that was actually prematurely canceled in the early 2000s because it made the pros look bad. Just look how bad that is. They were supposed to keep running the contest into the future, but they just kind of canceled it at one point without even mentioning it ever again. And you can probably guess why that happened. Now, I could go on all day about the statistical proof behind index investing, but I think by now you probably get the idea. So remember that study I showed you at the beginning where only 0.5% of those stocks delivered 3/4 of the gains? This is why it is so hard to just have individual stocks in your portfolio. This is why it is so hard for professional fund managers to be able to beat the index. It is highly unlikely that you are going to own this perfect little group of stocks that delivers most of the returns. But if we invest in index funds, then we are almost basically virtually guaranteed to own those stocks since we are buying a massive group of stocks. That's what an index ETF does. So if you thought this was really interesting and you want to learn more about this topic, make sure to subscribe to my channel because I am currently working on right now some more videos about this topic, including exactly which ETFs I like to buy, how to buy them, and what exactly is inside of an index ETF. And with all that said, thank you so much for watching. Hope this video was helpful, and I'll see you again soon.